This is Dale. A lot of my mentees question which one's better, credit spreads or debit spreads. And I thought it'd be a nice topic for the video, and that's what this video is about. It's an interesting topic. The similarities are very close to one another. But there are some times when one is better than the other. Of course, I specialize in credit spreads, and I've been doing this for many years. So I tend to believe credit spreads are better, but debit spreads will get you the same good investment. Again, my name is Dale Brethauer. I've been trading for a long time. Hedge fund manager. I am the founder and options coach at www.optionsinfinity.com. I do specialize in credit spreads, been doing this for a long time, publicly releasing my alerts for now 11 years. And we are extremely profitable, averaging about 75% winners per year. And I'll show you our equity curve towards the end of this presentation. This is an option chain. What we're looking at here on the left-hand side are calls. What's in the light yellow are the in-the-money calls, and these are out-of-the-money calls. Now, at the time that this screenshot was taken, the price of this particular, I think I was looking at Apple, was right around, no, couldn't have been Apple because Apple's not that expensive. Was right around 425. So that's at the money. This is at the money. So anything above this on the call side is in the money. So let's take a look at this. If the price is 425 and you want to buy a call at 420, okay, it is $5 in the money. Okay, so it has a value of at least $5, and it always has time value. So you can see that the value on this is 13.6. So you've got $5 of real value, and then it's $7.60, $8.62 of time value. Okay, these are out of the money in the white. So if we look on the put side, again, when we take our example, let's say we're looking at the money at 425. Well, a put at 420, of course, is out of the money. Okay, these are out of the money. This is out of the money by $5, but yet it has an $8 value. Okay, an $8 value, and that's the time value of out of the money options. Again, the in the money put options are the ones in yellow. Now, for a credit spread is where you're selling. In this particular example, let's look at a put, a bull put. Okay, we would be selling an out of the money option, and let's say we're selling the 425, and that would be at $10.12. Then you're going to buy one further out of the money, and that's 420. Okay, and that is only $8.27 for a net credit now of $1.84, because you sold one for $10.12 and you're buying one back for $8.27. Okay, so you're getting a net credit of $1.84 right off the bat. Okay, now a debit spread at the same strike prices works just the opposite. The debit spread is where you're going to sell an in the money option and buy one further out. So we go across over here. Now these are in the monies. Okay, so if we sell what we're going to do is we're going to sell the 425, and it is sitting here at $10.41, but we're going to buy the 420, okay? And that's $13.62. So the net debit, we're going to have to buy that for $3.20. Debit spread, you're going to buy the option spread for $3.20. That's the most you can lose, okay? Credit spread, you're going to get $1.84. You can lose more with a credit spread, but if we manage it correctly, that's never going to come into play, okay? And most times when you sell the credit spread and then buy one equivalent as far as the debit spread is concerned, it's going to be like $7, $8 on a $10 spread. So that's, yeah, that's the most you can lose, but that's more than we're ever going to lose on a credit spread. So a lot of people say they like debit spreads because it captured loss, but on the other hand, the loss can be quite large. Now let's just take an example here. Let's set and put on a spread right here, and let's look at putting on a spread that's a bull put and a bull call debit spread, a bull put credit spread. What you're doing is you are going to sell one out of the money, and then you're going to buy one further out of the money, okay? This one has a higher value, okay? So you're going to get a net credit because you're selling this one that has a higher value, all right? For a bull call, which gives you the same setup really, what you're doing is you are buying this one that has a higher value, but you're selling this one, okay? So you're buying one that has a higher value than this. So for a bull call debit spread, you are going to be putting money out, okay? You have to buy that vertical spread. For the credit spread, you're going to be getting a net credit, so you're going to be bringing that money in. Now, the beauty of credit spreads, the beauty of debit spreads is that you don't have to have it go in the direction you're looking for right away. In this particular example, it went in our direction, but then came back, kind of went sideways, and then ended up right about even. Okay, and that's the beauty of credit spreads. As long as it can go, you can make money if it goes up. You can make money if it goes sideways, and you can make money if it goes down, as long as it stays above where you sold and bought. Now, on a debit spread, you'd like to see it go in that direction, similar to when you would buy a call. You'd like to see it go in that direction, because with a credit spread, we are sellers. So the time value, and you just saw on that latest option chain we looked at, the time value can be very large. And time value is in our favor when we are sellers. It's not in your favor when you are buyers. And that's the difference. That's the biggest difference I see between credit spreads and debit spreads. That's why I like credit spreads. I like that time value in my favor. Just to show you that they're both similar, this is a risk profile of a bull put credit spread. This is the max you can lose. This is the max you can gain. And this is the green is at expiration. Of course, we're managing this on a daily basis, and that is the purple line. But this is the risk profile of a bull put credit spread. That is the risk profile of a bull call debit spread. They're identical. They are identical. Okay. So let's think about this a little bit more. Talked about the time is in your favor, and I think that's the biggest difference between the two. With a debit spread, you're going to have, as it gets closer to expiration, of course, what I teach is we don't ever get close to expiration, but you don't have to worry about assignment because it's not in the money. Well, occasionally, if it does get in the money, we're going to probably have exited a long time ago. Whereas a debit spread, it's a good possibility it's going to be in the money, and assignment is possible. Now, assignment is not as critical as it used to be, and most brokerages will take care of that for you quickly. But a lot of people are a little bit leery of being assigned. What do they do? Well, it's pretty easy. You just call your broker and you say that I wanna then sell the stock that's been assigned to me. So it's a pretty quick transaction. You're liable to lose a little bit. I don't like to be assigned. It's another degree of complexity in the whole process. You don't have to worry about that really with credit spreads. The bid ask is usually tighter because the value is only the time value versus on the debit side or on the call side or the debit side, the value is higher because you have both the time value and you have the intrinsic value. So the bid ask spreads tend to be a little higher, and you get better fills here with credit spreads. The other thing is I've been doing this for a long time, and I am just convinced that, and this is how I've made my money for many years, the credit spreads are the very best instrument, and debit spreads will get you, it's debit spreads are better than buying a straight call or a straight put, absolutely. But if push came to shove, I'm going to pick a credit spread. And here's the chart showing the exponential decay of that time value as you get closer and closer to expiration. That's in our favor. So I just went ahead and did a random study of credit spreads versus debit spreads for three-month studies on Target, Lilly, and Costco. The premise is I wanted a high probability trade, so I was using a 0.2 delta. 0.2 delta in layman's terms basically means that you have 80% chance that option is going to expire worthless. So it's a high probability trade, and that's what we set up here. And this is the first one you see. This is Target. We set this up, and this is, you can see just visually that this is a high probability trade. We've sold this one and bought this one. Okay, and on a debit spread, you have bought this one and sold that one on the call side. And you can see as we go through here, this is the initial outlay that you had to make on a call debit spread, whereas this is the credit that you got on a credit spread. So yeah, the bull call debit spread. This is the max you can lose, but really that's about the max I can lose here because it's a 10-point spread and I'm bringing in $1.90. So the max I can lose here is $8.10. Very close to what I have here on the potential loss here because this is what I had to purchase, the bull call. As we go through here, when you come over here, not much has happened. They're both about equal. Now it's gone in the wrong direction, and they're both losing about the same amount. And we finished just about where we were in the beginning, and you can see there's not much difference at all. So the only difference that I see on these two was that I am the seller. I am the seller. I'm bringing that money in. The other example on Eli Lilly, it's kind of the same thing. You've got your risk is limited to $8.27, but here the risk is really limited to $8.50 because it's a $10 spread. I'm bringing in $1.50. Okay, so the max is $8.50. I'm never going to take it all the way to expiration, so I'm not even worried about that. Okay, but as we go through here, you can see that the Costco was up and then just about even and then down, and these are just about the same, and that is true. That's going to be true for any scenario we look at. The differences between the two is not that great. They're both great instruments. They're both better than straight calls and puts. They're both better than selling covered calls. They're both better than actually buying the stock outright. Once again, just to refresh your mind, time is in your favor with credit spreads. You don't have to worry about assignment. It's a tighter bid-ask spread, so you're going to get better fills. And I've been doing this for a long time, and this is the winner right here. This is a chart showing my return on margin since 2019. I've been doing this for 11 years. I could show you the equity chart for 11 years, but I wanted to also show you, shorter term how I've been doing. This is originally the coronavirus scare. Yeah, we had some losers until we got on board with some bear calls, and then we picked back up and off we went. This is the kind of equity curve you want to have. This is a positive expectation equity curve. And these are based on the alerts that I send out to my people. When I see a trade that I'm going to make, I send out an alert. These are both text and email alerts. And what I like to do is have you all join me and get those alerts. You also get once every 2 weeks we get together, and I get together for about an hour with my mentees, and we talk about the current trades and what my feelings are on it. And I usually have a little bit of lessons to bring in. The strategy that I use, I've been doing this for a long time, is very simple. I like to keep things simple. However, it takes a while to master that. And right now I'm offering new members, if they're with me for 3 months, we give you the 4th month for free. So once again, I'd like you to all consider this. Go to my website, www.optionsinfinity.com, and join our community. I hope you enjoyed this video. Bye-bye now.